Welcome everybody to the next webinar, Developing Superb Trading Strategies. Yeah, my name Stefan Friedrichowski, and for the records, of course, I have to mention the date. Today is the 6th of October 2016, 11 o'clock as usual for this kind of webinar. Yeah. A warm welcome once again to everybody. It's a pleasure for me to have you here within the webinar, and thanks to Argus FX that they make it possible to have those kind of webinars. First of all, before I start, I want to make a remark, or I have to mention that the next webinar is not next week. It will be in 14 days, because next week, let's call it, I'm out of the office. I'm do a seminar in 4 cities in Germany, moving around from Munich up to Berlin, via Frankfurt, Düsseldorf, and Hamburg. So next webinar in 14 days, but you will get the email as usual, so the invitation will remind you. Yeah, topics for today. Of course, once again, question and answers from last week, and as always, I want to mention that you can, whenever you feel there's a question you have in mind, just send me an email. You see my email address, Friedrichowski, complicated last name, I know, at argusfx.com, and you can simply get in touch with me via email, and maybe we do additional conversation via Skype, whatever you like. So that's only an invitation. I want to share your thoughts, maybe as well here in the webinar. If not wanted, you have simply to mention. So everything can be private if you want, but only you have to say it, of course. Yeah, topics today, question and answers, as usual. Then today I do not want to make it that complicated, maybe like last week about entropy and information gain, something like that. Today I want to share with you some more basic approach for trading strategy, and this is simply based on seasonals. Of course, you have heard seasonals before, I'm sure, but after an introduction to seasonals in general, then I want to develop a strategy here, once again with an Excel sheet, and that kind of strategy will be based on the Dax, and the basic element are the weekdays. So whether we have Monday, Tuesday, Thursday, and so on. And we use one single EMA value for filtering the direction, not only the direction, or filtering between bull and bear markets. That's a better description. And once again, we will review 2 ongoing strategies. Today, the so-called Goldjunge 1, or based, or the underlying is gold, and the other one is the Forex pairs on a D1 base, traded with Bollinger Bands. As usual, you know, you can reach the recordings via my YouTube channel. I know it's nobody can remind those letters here, but maybe you make a screenshot, then you have it always there, and then you can link it directly to your browser. Okay, let's start. About questions and answers last week. Within exactly that YouTube channel, that's another communication channel as well, somebody did make some remarks on entropy trading. So if you want to see the full conversation, no problem, just go back to the to my YouTube channel, then you can see what we have discussed there. And I cannot recap here everything. It was about entropy, going for maximum, going for minimum, because there was somebody mentioning an article of John Ehlers, and yeah, and only the wording maximum enters in a strategy, but we don't know exactly what he maximized. So therefore, it's difficult to say whether he's doing something totally different, or maybe he has a -1 in his calculations as well, and therefore minimizing and maximizing might be exactly the same. So it's hard to tell. But nevertheless, out of that conversation, I put on the slide some interesting web links, and there's even a podcast. So maybe good idea once again to make simply a screenshot, then you have it. And if you have questions, you can have those slides if you want, just sending me an email and I will send around the slides, so then you have directly the links. By the way, this John Ehlers is quite an interesting person, and you may do your own research in the web about John Ehlers. There are some nice websites, and some good descriptions and articles you can find on his website. So very interesting, and we will have follow-ups on that as well. And there, the one who did make the conversation mentioned a podcast as well. I have not been in the podcast already, but maybe I would give it a try at the weekend. Okay, but now let's start with seasonals. And I simply call that slide the mother of all seasonals. And the mother of all seasonals in the context of trading, therefore we have to step back first, because the mother of seasonals is not trading for sure. No, it's a climate. It's like something like this, by the way, that is where I live, in Dresden, and yeah, there's they measure the weather at that is the airport of Dresden, and yeah, then you see exactly the picture like this, and you can interpret it by your own. I know everybody has seen similar charts wherever you live. At least if you live in the northern sphere of the Earth, then it will more or less look like this if we don't go too much south. So we have highest temperatures in summer, lowest temperatures in winter. Even high values and low values differ to some extent, and in this case we have the number of days with temperatures below zero as well. And I assume, when I look to the picture here, this might be old and not been updated over the last couple of years, because I cannot think that we have still that much days with temperatures below zero because of global warming. But that's not the topic for us today. So what do we have? We have a change which repeats. So that is something which is the basic element of seasonals, even when we go further to the trading seasonals, that we have a typical kind of behavior over, in this case, it is a month, but over something, it might be later, weekdays, whatever you think, but that is. You can even think about unemployment rates. You have heard about, or you get in the news about unemployment rates, and sometimes they call it, those data are seasonal corrected. This seasonal corrected is the same that we more or less subtract the overall change within the year from some data, and then we get seasonal corrected data. So that is phrase from doing statistics, or which for some underlyings or for some topics, it's the right way to do. To have something like this in our charts, we can use for the trading approach. But there's another, I now call it the mother of the trading seasonals. That is not something which is related directly to months or days or weekdays or hours or whatever. No, it's the most famous trading example is the US presidential election cycle. This chart here has a history of more than 100 years. And the basic idea is the question, every 4 years, the US guys, they elect a new president. And now the sequence of the years is divided in 4 years. So the year of election, the post-election year, the midterm year, and the pre-election year. So that is the typical or the separation of those kind of datas. And then what has been done, one has averaged this 100 years of the past with respect to the beginning of the election year. So there, everything is set to 100, and then we have the change over the next 4 years, the typical change of the Dow Jones index. And of course, we can see something within even that chart. Especially what we see is that this third year is a year with more or less no change in the Dow Jones. Always we have the question when we look to data like this, is there enough statistical evidence to use that kind of information? Yeah, to answer this question exactly is, at least for me, more or less impossible. But what we can try, at least if we do normal trading, we can use this kind of behavior. I will always call it as a bias, as an edge of our trading. So this would tell me in this midterm year, there is no overall bias for the Dow Jones. So either I stay out of the Dow Jones within that year, or I can use it differently to say, in this case, I can look for long as well as for short entries because both are possible. This would be a little bit different coming to the pre-election year, especially for the first half of that year. I would have a strong bias to the long direction, or more or less to say, I will never open any short trade. I only will go for long trade. So that would be the interpretation of this graph. So therefore, one has to look where we are in the election cycle, in this 4-year period cycle, and then we can use this kind of information as bias. We have put some seasonals as well on our homepage. Unfortunately, I have not prepared it, but it takes me only a second. On our homepage, you will find some additional seasonals for some underlines. So we have here the link to seasonals. And for example, this is over the last 10 years the seasonal of the DAX. And you can see a few things which have entered, for example, the normal saying, like at the end of the year we have this year-end rally. Can be confirmed statistically looking to this kind of graph. So starting in September, in average over the last 10 years, the DAX behaves like this one here. And this other phrase, like sell in May and go away, you can find here as well. Because between the end of May or mid of May and end of August, there's not happening that much typically within the DAX. And by the way, for the first 2 months as well, there's more or less no change. So we have the most important changes between mid-March until mid-May, and then starting at September to the year end. This is an average over the last 10 years, nothing else. Once again, how to use? Yeah, I personally can use this only as a bias. I would not automatically try to trade exactly that curve. So to say, on the 1st of September, I open a long trade on the DAX and do nothing until Christmas and sell that position and don't look to the behavior in the time frame in between. That would be, I think, a little bit too easy. And why not to do that? Simply because here, at least, the statistical evidence is not good enough to say it will be. So this kind of behavior is a will be behavior in the future as well. So, but we can interpret it, that kind of graph, and take at least the information for our discretionary trading. There are other examples, like, for example, let's go for gold, where we have not the same, but we have a typical behavior as well. So once again, you have more or less 4 separate periods. The starting of the year would be a long bias, then a no bias, and from the 1st of July onwards we have a long bias as well, but already stopping with the beginning of September. So we can see those things, and we have done some additional as well. If you scroll down here, we have done it for the individual months as well. So, but always this can only be taken as a bias for our own trading. I would not trade directly the prediction of that graphs. What I want to do now is to go back to seasonals in general. So the general approach of seasonals is quite simple to be described. You look in general for something which cyclic repeats. And those kind, let's call them events, can show up a typical pattern. So think back to the climate of Dresden. Of course, there is a typical pattern over the months, and or even you have events like this election cycle. Then it creates a typical pattern. In this case, on a 4-year period. But what kind of events I'm talking about? Events, maybe is the wrong English word here, by the way. It simply means the thing we look for. It might be months, like in the climate chart of Dresden, or it may be the day of the months. So think, for example, following the hypothesis that big funds open new positions on the beginning of a month. That would mean that typically those stocks would increase at the beginning of the month, because then there's a buy pressure on the market. If we do an analysis like this, one might find a proof for that especially always at the beginning of a month, stock values might increase a little bit more than at other days of the month. Another way could be just to look for the day of the week or the weekday. So like Monday, Tuesday, Thursday, and so on. By the way, this is what we will do with the DAX analysis. But you even might think further in going the time frame down that even within the day there might be a typical behavior. At least what we know, for example, is that during the night there are some typical forex pairs or S&P 500. At least they might only flatten down, but of course that we know, and we cannot trade, especially that kind of situation. But you might think or you might analyze underlyings with respect to the hour of the day. The basic assumption of all seasonals is, of course, everything repeats. So whatever we will find out has an evidence for the future as well. So it should repeat. But by the way, that is a general rule of trading as well, because whatever kind of approach you have for your own trading, you have some experience from the past, either statistically or just by trading, and what you do is you apply that statistics, that history to your future trading as well. So, the only thinking behind is everything repeats. So what has been good over a certain history will be good for the near future as well. And that's the way you might look for entries at resistance lines for whatever you take. Everything follows the basic assumption. It repeats, nothing else. So, but now we apply some rules for the DAX, or better to say it will be the FDAX, and the day of the week, and establish a trading setup out of that. The procedure, how to develop such a strategy, and I will show it in my Excel sheets as well, but I want to introduce first 5 questions, and by answering those 5 questions, the strategy can be developed. The first question will be, do specific weekdays show up different fluctuations? With fluctuations, I mean simply the difference between high and low, and nothing else. So there's a question, or the underlying question is, do specific, for example, is Thursday a day with more fluctuation than the other days, or Friday when everything ends maybe with lower fluctuation? So that is the first question. The next question is a little bit more specific already. Do specific weekdays show up a bias into long or short direction? That would mean, if you would find out, we find a correlation between the day of the week and the direction of the day, that would be absolutely nice, because then we would say, okay, Friday is a short day. Let's go on with short trades on Fridays. So that would be very nice if we can find out something like that. And since you may already think that the first 2 questions cannot be answered with a clear yes. Therefore, what we need is an EMA filter to separate between bull markets and bear markets. And you will later see that all of a sudden we find a very strong correlation between weekdays and going long, going short on that specific days. So only one EMA filter will help us to have the second question to be answered with a clear yes. And since we find a clear yes on this correlation, we know now that we can build up a strategy out of that. Doing so, of course, the first thing is we apply a simple rule, which would mean we would trade with a fixed lot size without any stop loss. Of course, I will not do this, no. But that is more or less only to answer the question, how many DAX points can we get out of this kind of strategy? That other way around, this would mean trading with a fixed lot size and nothing else. But of course, 10 years ago, we have a complete different situation than today. Therefore, this is not the final step. The better final step is to introduce two things. One is we introduce a real stop loss level as always for our trading activities. And by doing so, that means by having a stop loss level, then we can once again turn all the calculation in the units R, so the risk unit for all trading strategies, which is always the better way, instead of looking how many points can I earn with a certain strategy. How will I do it here during the webinar? To do it absolutely manual between all those, or between this Excel sheet, and to have it finalized would take a couple of hours. So I will do it in a way that I make it more or less step by step with different Excel sheets already prepared, so it will look like this here. So I have Excel sheets labeled with from 0 to 4, and then the final one. There's always only something being added to the Excel sheet. I could immediately go to the final one, but then you will have too much information at the same time. So let's do it stepwise. Okay, the first step is, as always, of course, having those data. In this case, we have, I will use the FDAX values. That means we have values within the day. We would have values between 8 o'clock and 10 o'clock in the evening, 10 p.m. And those data go from 1999 until the sheet ends in May this year, but that doesn't matter. So this is our base. That's our price base. There are different sources, by the way, for that. The easiest way is what I have already mentioned in the previous webinar. In this case, would be this website stock, but spelling a little bit differently at the end with a Q and double O. So stock.com. That's a Polish website, and there you can get those data. For example, the source here is a little bit different. So having those historical values is, as always, the first step. The next step, later, since I know that I have to build an EMA. Once again, the kind of calculation done here is quite simple. To calculate the EMA, we have in cell G11, we have the EMA period, and then the EML values being calculated downwards. Then you see another, maybe I can enlarge it first here. That's quite simple, because we have to distinguish later between the days of the week, and there's an Excel formula which is simply called weekday, surprisingly, and that gives you back a number, and this number is between this is, in this case, it is between 0 and 6. And starting the 2 is a Monday, 3 is Tuesday, and so on and so on. So we, by calculating this number, we know exactly what day of the week we have. And then what I have done here, I looked for the change of a day. So that means I looked here, by the way, to the difference, the percentage difference between high and low, and in this case divided by the open, and this is nothing else than the percentage change during that day between high and low. And you see already with that Excel sheet that the numbers are always in the right column. So all the Mondays are in the column E, and later here you can see they are always in the right column. And yeah, if there's something like a gap like here, that has to do, maybe there was a day off in Germany, or I don't know, whatever happens there. Otherwise, they are automatically sorted diagonal here downwards, and that means I can have a look individually to all Mondays, to all Tuesdays, to all Wednesdays, and so on. And how does it look like? Because now we can answer the first question of my introduction, and that was, what about the typical change? Is there a big difference between the different days of the week? And the simple answer is no. Yeah, there is something a little bit. So Thursdays have the highest change. Thursdays have the highest average changed between high and low, and that might be, but it's only, I cannot prove. The reason might be simple, that we have, for example, this interest rate decisions on Thursdays in the US, but I don't know. But nevertheless, the differentiation between them is quite small. So yeah, Monday and Friday have the lowest values, and Thursday the maximum value. But I think more we cannot take out of that chart. And maybe just have a quick view to the data itself. That is the FDAX starting at 1999 until 3 months ago, and yeah, the usual picture, which always would tell us, hey, trading is that easy. If I look to the historical chart, then you know exactly what to do at what point in time. But everybody of you knows trading is not that easy, of course. So first question can be answered, no. The typical fluctuation of a day, there's no correlation, no real correlation to the day of the week. Let's go one step further. And now the question, I want to distinguish between, now I go for the difference between close and open, because I later I want to use it for the trading results. So going a little bit more here in. So the calculation now is done, the percentage change with sign. That means all the numbers now have a sign, because we don't have the difference anymore between high and low, which is always positive. But now we look for the percentage change from open to close within the day, within a specific day, and we separate once again everything according to the day of the week. So now we have signed values here, and maybe I can make it a little bit visualize by highlighting everything with red if it's minus. Oh, but I need some decimals. So now we have it. And you see there are days with the plus and the minus and so on and so on. And now we can ask, is there an average, a typical day now with with sign? So it's we average over all the Fridays, all the Mondays, including the sign of the change. And now it's already a little bit different, the typical behavior. What does this kind of behavior mean? It would mean, in average, on Mondays, the price goes up. And we would have the biggest increase on Wednesdays. That is what I can get out of that kind of picture here. And what I know is that Fridays would have a bias to short. So only taking exactly this picture and no information further, then, yeah, on Fridays, I only would look for short opportunities. And on Thursdays, I would more or less do nothing. And the first 3 days of the week, we would look for long trades. So that is the conclusion we might take out of that graph. At least what we have is, we have a slight better separation already between the change of a day, now it's a real change from open to close, and the day of the week. Since the numbers are small, the correlation is still not very strong, but at least we see something. And now the big question is, what if we do one additional separation? And the separation might be and will be, are we in a bull market or is it currently a bear market? So the question is how to define. Of course, as always, looking to the chart afterwards, I can clearly define this year being a bull market and 2008 being a bear market. Of course, it's easy looking back. But just a second. Now I'm back again. Maybe we can do it quite simple. We just asked ourselves, we take an EMA and do the normal definition like prices above EMA is bull market and prices below EMA are bear markets. Maybe that's all. So let's try to use that kind of filter in order to revisit exactly that graph here, the typical change at a specific day of the week, with the additional information, are we in a bull market or in a bear market? And that's now what we can do next step. So first of all, it's quite easy to do it. So what we have done already up to now was this part. This was done on my previous Excel sheet, and now we simply divide it once again in two. Now, sorry, what we have done was the first, and now here is the second analysis. Bull markets and bear markets, and that's all. So we have an additional element within that Excel sheet, and the additional element now is the question, is the price above EMA or below EMA? And that's the first part within this if command here. So Maybe I can show it a little bit better by pressing here. And then you see, hey, we compare the open of the today's open with the EMA of the previous day, and this EMA is based on the close of the previous day. So we do the comparison on the base of the open, and if that open is bigger than the previous day EMA value, then we say we are in a bull market, and if we are below, then we say we are in a bear market. So we simply take all from the previous Excel sheet now in these two separations for bull and bear. And then we can do the analysis once again. And now we get a picture like this. And what you see here is the average price change versus the day of the week for the two different situations. All the blue bars are bars related to the bull market, and all the red bars are related to the bear market. Maybe you still don't understand exactly what that kind of chart tells you, but it tells you a lot. Let's look for the best day at all, the Tuesday. And now it comes a little bit surprising, if we are in a bear market, so EMA goes down and the price is below the EMA value, then the typical movement on Tuesdays is upwards. So within a bear market, the typical change goes on Tuesday in the long direction. On Fridays, it's exactly in the direction one would think. That within a bear market, I should go short, and yeah, that's correct. But on Fridays, on Thursdays, and on Mondays, on Tuesdays and Wednesdays, no. Even in a bear market, we have to go long. And that is the way how we can interpret this chart here. Let's do the same once again for the bull market. Surprisingly, even being in a bull market, that means the price is above the EMA of the previous day, we would enter short positions on Tuesdays, no long. Long is only on Monday, Thursday, and Friday. So we have now a separation between the day of the week and being in a bull market or in a bear market. That sounds already promising, but how much? So what we can do now is we use that kind of information and add up all the changes of the DAX. So once again, let's look here. Now I build up the sum of the movements in DAX points within the Excel sheet, separated once again in bull market and bear market. So it's the same table as to the left, but now in the real change value of the DAX itself. So we have those two tables, one for bull, one for bear, and then we can add up those price changes, or better to say points within the DAX, and have a look to, let's call it performance. And here we are. So what we have here is the sum of all those DAX points over the last 16 years, applying the rule described in that colored table with red and blue. So always on, and now I have to look, not to say something wrong, always to enter long positions in beer markets on Tuesdays, and so on and so on. So if we apply those rules, then we get exactly that summation of all the DAX points. Trading-wise, this would mean entering every position without any stop loss, because there's no stop loss. We start our trade at 8 o'clock. The trade ends at 10 p.m., nothing else. And then we take or get whatever has happened within the time period. No stop loss, no take profit, nothing. So there might be days which go very far into the wrong direction because we don't have made any stop value. So that's not the way how to trade, but we can do the next step. Let's go further within that Excel sheet. And the step further is simply, let me move to the right. The step further is simply that we now apply a stop loss level as well. And in this case, I use 1.1% for both beer and bull market. And since now I have a stop loss value, I can ask myself, I can do the calculation once again in R. So whenever I have a loss trade, it will be a -1 trade. During the day, because the trade opens at 8 and ends at 9, I should not, at least in 99.99% of all the days, I should not have that much gaps or slippage, because it's only within the day and we don't have any position in the time gap from t p.m. To 8 a.m. the next day, because there's no trade open. Therefore, I don't have, so every trade which goes into the stop loss gets a value of -1, but that's not enough. Finally, I will include a spread as well. So I apply here a 1-point spread within the graph or within the calculation, and we get our equity line looking like this. For this strategy, following the idea of having specific trade directions depending on being in a bull or beer market, defined by an EMA, in this case with an EMA period of 20, and applying that rules, then we get exactly this kind of equity curve here. So it looks quite nice, not that bad. As nearly always when we look for DAX right now, is the short-term history not that good. Like here, the end of the graph. But same situation was already in the beginning of 2014 as well. Yeah, but as always, every strategy has a drawdown. But at least that is how we can derive a complete strategy. And if you're interested, I can share with you this Excel sheet as well. Let me summarize. This kind of strategy and how it really works, because it's quite easy to do this kind of strategy practically. Let me first move to the last line. What we have to do is we have only 2 actions a day, and there's one action which is at 8 o'clock in the morning, and there's another potential action at 10 p.m. That's all. And even that action might have vanished because the stop loss has been reached. So practically, we would do this kind of strategy in the morning at 8 o'clock. We would compare the open of the FDAX with the EMA value from end of last day. That's all, because that defines whether we are in a bull or in a bear market. That was the first separation. And by the way, in most cases, you know that result of this comparison between EMA with the period 80 already directed at the open of the market, because it's not that close and that much happens not that often during the night, especially for the FDAX, because the FDAX ends at 10 p.m. So yeah, whatever. So that is the first decision we do at 8 o'clock, and we define bull or bear market. And now it's simply the question within the bull market on those days, Mondays, Thursdays, and Friday, we enter a long position, and otherwise we go short within the bull market. And within the bear market, yeah, it's more or less exactly the other way around. On Tuesday and Wednesdays, we go long, and otherwise we go short. That's all. The trade gets a stop loss, and the stop loss is simply 1.1% away from where we enter. So from the open of the market. So that's all. Of course, in long positions we have to add we have a minus, and for short positions we have to add those 1.1% to the price value of the open. And now we have to wait until 10 p.m. and if we have not reached the stop loss in the time between, then we close the trade at 10 p.m. That's all. So it's quite an easy kind of strategy. You don't have to do that much. You don't need anymore this Excel sheet because the EMA 80 value, let me write it here down because then I have it, with a period of 80, yeah, we can do within the chart that kind of comparison, and that's all, and then we know what to do. Maybe because that strategy is that simple to copy, to follow. Once again, whenever you do it on your own risk. This kind of risk disclaimer is always on the first page. I have not read it every time, but I think this is a good time to repeat it. So whatever you do always on your own, of course. So, but it's a nice strategy based on a seasonal, and in this kind, this time, the seasonal is the day of the week, filtered with an EMA, in this case, EMA value 80. By the way, I have done similar studies for, just for example, S&P 500, and it works. And I have done it for US dollar, Japanese yen, and it works as well. Of course, the days, they differ, and no question. So what to do on Mondays, Thursdays in bull and bear markets? Of course, it's different to the DAX situation, but overall, it works as well in those underlyings, and other underlyings I haven't tried because I simply have stopped investigating it for additional underlyings. Yeah, so a very nice strategy, quite easy, quite robust, because those values are not, let's say, exact. If we move around with the EMA value, yeah, we get slightly different values in the equity line, and if we move around with the stop loss level, once again, we move around a little bit with our equity curve, but there's a so-called plateau for those values. That means we can change it if we want. Okay. Then, as always, I want to have a look on two strategies once again, and in this case, those two strategies are so-called Goldjunge. Goldjunge 1, the name is quite old already, I think 3 years old, or 2 years old, I don't know. It's a breakout strategy entering with two potential entries. One early in the morning at 6 o'clock, and the other one is at 11. short trades would only be opened early in the morning, long trades only at 11. There's a filter within, once again, it's an EMA. So potentially this kind of strategy is doing 2 trades and normally only 1 at all. And now for a longer time, there have been no trades at all because we have a minimum breakout range, which is quite important for those kind of strategies. If there's not enough volatility in the market, not enough changes, then you should not go into a breakout strategy, at least if this strategy is running originally, what always means that the stop loss is on the opposite side of the range. And if that range is quite small and goes down, let's say, into values like the spread itself, then of course a breakout strategy should not be traded. So that is the one strategy, and the other one is the so-called Bollinger Reversal D1. Yeah, this strategy is, as the name tells you already, based on 2 Bollinger Bands, and they are quite similar. One is related for potential entries, and the other Bollinger Band is related to the stop loss. And by the way, in this case, the stop loss after entering a trade is moved around with the second Bollinger Band, but of course only into the, let's call it the direction of trade, so never enlarge the stop loss. The trade direction has a filter. Once again, it's an EMA, so in summary, quite simple. So let's have a look. Let's start with the ladder, because then we can have a look practically, that I can describe you a little bit better what I mean with those 2 Bollinger Bands. And you see within the chart 2 Bollinger Bands, one in red and one in, let's call it blue. And then there's a central additional line, which is the EMA value. By the way, in this case, this is close to the period of the Bollinger Band itself. And it's not quite easy, I know, to already see exactly how the strategy runs, but let's focus only on one example. I go exactly to the right on my screen now where my cursor is. Then you can see there's an open pending order, and this pending order is a buy limit order, and exactly at the level of the lower end of the inner Bollinger Band, and the stop loss is downwards to the outer Bollinger Band, and we have only a buy limit order. Reason: our EMA goes upwards and our price is above the EMA, and therefore we only would trade, I call it a correction. A correction in the sense price has to go down, and then it should go upwards once again into the overall direction. So that's the way this strategy is running. And just as another example, let's have a look here as well. There's an ongoing trade, short US dollar, Japanese yen, and here you can see, okay, trade has been entered somewhere here, this short trade, and now already the stop loss level is below entry, so the trade is safe. And reason for doing so has been the outer Bollinger Band goes down and down, and therefore we have already the stop loss level now in this region. And looking to the current situation, it might be that the stop loss will be hit, maybe even today or tomorrow, but still the trade is safe. Okay, this is one strategy, and now let's look to how it looks equity-wise. No, that's the wrong one. And it looks like this. So the history is starting December last year, and still, as mentioned already last week, it's quite difficult right up to now. Overall, nothing happened much. So, but it is as it is. We are slightly in the minus with this strategy as well with the other one. But here you can see with for the so-called Goldjunge exactly that during the last couple of weeks there have been no trades at all, and the reason has been simply because there was too less volatility in the market. The ranges have been too small, and therefore no trades. Unfortunately, the big short movement, I think 1 or 2 days ago, was not within the strategy. That was be nice because the movement before there was a range, yeah, but this range was too small, and therefore there was no short trade stop in the market, and therefore we missed that nice opportunity. I think it was 2 days ago, but still it's okay. This loss up to now is practically, so I don't. I'm not worried about this kind of strategy. We need movement, of course, as always, and as long as everything stays with the interest rate as it is, then nothing happens. By the way, this short movement within gold was has been news driven because there was some rumor about future actings of federal EZB, so the European Federal Bank. Yeah. Anyhow, so that's for now. 12 o'clock already. So no, that's not for now. This is for now. So as always, if you have any questions, feedback, just send me an email. If you want to have the slides or the Excel sheets, once again, same thing. Just send me an email and I will send it around. Yeah, and then let's see. Hopefully in 2 weeks, once again, because in 2 weeks, next week is no webinar, but in 2 weeks we will have the next webinar. But you get the information via email as well. Okay, thank you for your attention and have a good day. Bye-bye.